stocks were relatively quiet as investors await Fed Chair Powell's speech at Jackson Hole. That's set to take place on Friday. Markets will be closely watching to see if Powell sticks with his hawkish tone. Our next guest says market watchers are too bearish on growth and too worried about inflation. Joining us now is Eric Freedman, U.S. Bank Chief Investment Officer. Eric, it's great to have you on. Let's start right there. Why do you think that's the case?
Yeah, Morgan, great to see you. I think really two things in mind. Number one, you think about the growth trajectory. There's been this almost dismissal by companies of giving really thoughtful guidance about what's in front of them, really because tariff confusion has reigned supreme. So we're starting to see that really peel back a bit. Think about the various sectors that are very consumer sensitive, whether that's leisure, hospitality, financials, the general consumer zeitgeist is actually getting incrementally a little bit better. Even though there's a lot of discussion around how challenged consumers are, we actually think that at the margin, consumers will be doing a little bit better on the spending front over the next couple of months and quarters. I think the second component is the deferral of decisions by companies is actually starting to really scale back. If you're in a sector and you've really held off on giving guidance, if you really held off on providing perspectives on your spend, it becomes a bit of a prisoner's dilemma. If you're the only one who's really keeping cards close to chest, that's actually not a good thing. So we think in general the growth picture is generally positive. I think the other point on inflation, the U.S. can't really afford to be an outlier on the inflationary front. Just to kind of look at economists' forecasts out the next, let's call it 18 months, economists think that inflation will still be above 3% in September of 2026 versus what we're seeing forecasts in developed markets as well as developing markets at sub 2%. So I think that in general, you're seeing this trend of really over-indexing on inflation and also harkening back on less growth. We just think that things will be a little bit better on both fronts than what economists are currently thinking about.
There's this funny thing happening in the bond market, and it's not just domestically, it's globally, and that is you're seeing the long end climb higher. And it's not just here in the U.S. either. You're seeing it in Japan, you're seeing it in the U.K. and other parts of the world right now. What is that signaling? Is that a reflection of how sticky inflation is globally right now, or is it something else?
Yeah, I think in Japan, it's definitely something else, Morgan. That's a bit of an anomalous situation just because of what's happening. Unfortunately, such a long period of latent activity in Japan. But really, I think it's an important point you raised because for us as macro investors, we want to see the 10-year sit between 4% and 5%. Sub 4%, that for us would be a growth scare. You covered that a little bit earlier in an earlier segment. Above 5%, that would signal to us that, look, we're wrong in inflation. And in fact, economists may be underestimating where inflation goes. So right now, the 10-year at about 4.35, that's actually a decent level for both borrowing to probably resume, pick up a little bit later on this year and early next. But again, that sub 4% number, that would suggest to us that consumers will actually really scale back. So, if anything, what we're seeing in Europe is a little bit of loosening of labor laws, a little more animal spirits flowing, which we think is a good thing. But in general, you're seeing the bias from central bank estimates for rates to come down. So again, long end of the curve, very modest pickup, but certainly short end of the curve. People think that ex-Japan, there will be some cuts to come. We think that's a great time to be involved in global equity markets, especially large caps at current levels.